Hello everyone. In this video I am going to talk about how we can make a portfolio using momentum factor. In the last video I talked about what are factors and what are the different type of factor that is being used in the industry. In this video I will discuss about the underlying philosophy of momentum factor and also show you how we can make portfolio using the momentum factor. I will use Nifty 50 data and make the portfolio of a 10 stock in the end. Now let's start with the underlying philosophy of momentum factor. The underlying philosophy of this factor is that recent market winner tend to continue performing well in the near future. It is similar to saying that we are riding the wave of a strong performing stock. In this strategy, we are going to choose a stock which have performed well in their near past. Now let me show exactly how we do this. Consider the universe of 500 stocks and I want to select top 10 stocks based on this factor. Then how we are going to select these 10 stock out of 500 underlying stock. Now let me state the philosophy of momentum again. Philosophy says that recent market winner tend to continue performing well in the near future. What do you mean by recent and what is near future means? Let's suppose that I want to make a portfolio for 3 months. On an average the holding period is 3 months. Then we have to see the performance of the last 12 months stocks. Similarly, if I have to hold the stocks for 1 month, then I will see the performance of 4 months. In general, we can say that it is the ratio of 4:1. If I have to make a portfolio for X month, means holding period is X, then I will see the historical performance of that stocks of 4X. Okay, so it is a ratio in the 4:1. Actually, this is a standardized ratio, but you can tweak it if you are backtesting with your own data. Now let's consider that we have a holding period of 3 months. Okay, and we have underlying 500 stocks. How we can come up with 10 stocks? We have given 500 stocks. First we will calculate the cumulative return of the last 12 months. Why? Because our holding period is 3 months. As previously you see that it is in the ratio of 4:1. If holding period is 1 month, then we have to see the performance of the last 4 months. Okay, so here in this case I have the holding period of 3 months, so I will see the performance of last 12 months. Okay, once I calculate the cumulative return of all the 500 stocks, then I will sort the stock based on cumulative 12 and then choose top 10 stocks which have highest cumulative return, and then I will make a portfolio using equal weight or mean variance theory. You might be aware of MPT theorem, or you can also give the weight as respect to their market cap, or even the weight can be proportional to the cum rate. So any type of factors, any type of portfolio can be built with the help of this strategy. The weight depends on the risk management kind of thing. For an example, one standard approach which is being used in the industry is that instead of cumulative 12, they are using cumulative 12 divided by standard deviation, for the same time period. If I am taking cumulative return of 12 months, then we have to calculate the standard deviation of the last 12 months. So this is an standardized and it is called the risk adjusted momentum. And over the years it has been seen that by following this method the drawdown is very less as compared to the raw cumulative return. Now I will show you the implementation of these with the help of Python. Let me show you first the step. I will take Nifty 50 as a universe, so I will have a 50 stocks and I want to select top 5 stocks based on the factor cumulative 12 divided by standard deviation, and then I will show you how we can make a portfolio using equal weight and based on proportional to cumulative 12 by standard deviations, and then I will show you the comparison between these two. Let's go with the code. Before moving forward, I want to make one correction that instead of 5 stock, I am going to build a portfolio which have 10 stocks in their portfolio. Now let's see how we can build this. Let me show you data first. I have taken the price of each stock in a Nifty 50 from 1st January 2020 till 15th of December 2025. I have taken 5 years of 5 to 6 years of price, and then I will select try to use this. I will first import some of the libraries like pandas and plotly. Second, I will read the Nifty 50 stocks. Then let me put date index, date as an index. You can use dot set index as a function. Now let's see what is the shape of the Nifty DF. It is 1481 by 50, right? You can also see tail because it is tails describes the last 5 row of a data frame, and you can see that the data is till 15th of January 20, 15th of December 2025. For your memory, I am just reviewing it again. We are having a 3-month holding period. Instead of 500 stocks as a universe, we are using Nifty 50, and we are going to calculate the top 10 stocks based on factors called momentum. We are not going to take a raw momentum. We are going to take a risk-adjusted momentum, which was cumulative return divided by standard deviation over the same time period. Now let's see how price for, let's take Adani as a stocks, how it look like. So you can use plotly by fixing X as a date like index and Y as a column of that data frame. If you see, then it looks like something on January it was around 201, and current it is around 2216. So approx 10 times over the last 6 years. Now I am just converting the entry of a data frame to numeric. If it might be possible that sometimes there are entries which are a string, so it will convert to a numeric format, and then I will see how it look like. It is looking like everything is non-numeric. Everything is numeric now. Let's calculate return by using percentage n function. You can also see the top 5 entries by using head. The first row will be nan, right, because there is no price before 1st of January 2020, so it will be nan. Let's see, tail will be filled. It will be till 15th of December. Yes. Now I will calculate the cumulative return over the last 12 months. We have the return of a daily, right? So to calculate the cumulative return of over the last 12 month, I have to take 252 days, because in a year there are 252 trading day. So you can easily find multiplying daily returns and then subtracting 1, then you will get cumulative 12. If there is some nan value, I am going to remove it. Now let's see how it looks like last 5 entries. Okay, I am also going to calculate the standard deviation of the last 12 months. It is something around 2.6 percentage, 2.5 percentage. Yeah, number looks on an average, so assuming it's correct. Now I will calculate the factor. Factor will be cumulative 12 by standard deviation of 12, which is equal to something around 6.2, 4.6 for Adani, and Adani port like 28. So it will vary lot, I think, because I have like this is risk adjusted cumulative. Now we will first calculate the, like, I want to make a decision on 15th of December, so I filtered out the last row, and then I will choose top 10 stocks having the highest factor. So the top 10 stocks having the highest factor is Maruti, Eicher Motor, SBI Life, Bajaj Finance, Bharti Airtel, Tata Consumer, Reliance, HDFC Life, Hindalco, Shriram Finance. Okay, now let me show you with the help of diagram. Okay, so this is a plot, similar. I just use the bar plot to use it. Now let's build up equi-weight portfolio. I can make a different portfolio based upon the risk management techniques. For this step, I am using risk equi-weight portfolio. So weight will be what? 1 by length of top 10. The length of top 10 is 10, so the weight will be 0.1 for each stocks. If you see, then it is 0.1 for each stocks. Now let's see the allocation using bar plot. It will be for each stocks it is 0.1, if I have to see using bar like pie chart, then it is something like this. You can use this function. It is like px.py values name, values will be weight dot values, and names will be weight dot index. Now let me show you factor weight portfolio. You can use it by, we know the factors, then weight will be factors divided by summation of all the factors. So this is factor divided by summation of all the factors. Okay. Now the factor weight is proportional to the to the factors. If you see the plot, it is something like Maruti got the highest weight, 15%, and then Eicher motor got 14% around. Let's see with pie chart. It is something like you can see. Okay, Maruti got highest and least got, I think Reliance got the list. No, Hindalco got the list. Okay. Oh, before in also, I think, sorry, Sriram Finance got the list. Let's compare these two portfolio, equate portfolio and factor weight portfolio, and let's see how it look likes when we are putting it side by side. Okay, so few stocks are having the higher weight than equivalent portfolio, and few stocks are having the lower weight than equivalent portfolio. I hope this makes sense how you can build the stocks, how you can build the portfolio of n stocks. I am taking here n as a 10, and then building different type of portfolio based upon the requirements and based upon the requirement for the risk management perspective. Thank you. Let's see you in the next video where I will be discussing about other factors. See you soon.